All right, Ken Orange Theory Trader, back with you with another video on a deep study of the 159 pattern. So let's get into it. So the benefits of trading the 159 Ken Range Theory model is that you have a set trading window between 9 a.m. and 1 p.m. That is the only time you're trading. This is Eastern Standard Time. Okay, all times are Eastern Standard, USA. It's a simple pattern to see, and it's very hard to miss. It has a built-in stop loss and take profit goals. It's really a done-for-you system. That's why it's one of my favorite setups to trade. So this is the basic 159 pattern. You have a range candle. This is a 4-hour chart, which would form by 1 a.m. Okay, 1 a.m. All right. The 5 a.m. candle comes in the next 4-hour block, which I like to call it the money candle. And then our trading actually starts right here on this 4-hour candle at 9 a.m. And we're looking at a open high low close model, or a if you're going short, or a open low high close model if you're going long. So let's break that down, and we're going to take this candle by candle, and I'm going to show you in detail what to expect from each candle. We're going to start with the 1 a.m. candle. These are just two examples of how a 1 a.m. candle could look. It'll look something like this or something like this. Okay, this is your trading range. Okay, ideally, we like to see the candle close near the top or the bottom of the range, but you won't always see that. Sometimes tight consolidation ranges can set up a big move later, like if it's less than half of the average true range. So, for example, if a pair moves 50 pips in a day, but the 1 a.m. candle is only 15 pips, then that can be a predecessor to a big move to come later on, typically in New York session. Okay, now, like I said, a close near the high over the low of the candle could be good. That's why these candles are gray, because it could be red or green. Doesn't really matter. All that matters is that if it closes up here, that's a good sign. There's less distance to go. And if it closes down here, that's a good sign, because there's less distance to go as well. Okay. It's good if the 1 a.m. candle makes that initial high or low of the day, but it's not required. And all trading should take place inside of this range. Okay. At between this candle's high and this candle's low, regardless of direction. If you're going long, you need to be going long somewhere inside the bottom of this range. If you're going short, you need to be going short inside the top of this range. Okay, so that's how it goes. All trading, and same thing over here. If your 1 a.m. tighter range can lead to a breakout later on, all trading takes place below the top of the range or above the bottom of the range. Okay, so, but again, these aren't two separate candles. This is how the 1 a.m. candle could look if it's large, okay, or if it's tight and more compressed. Okay, so that's the 1 a.m. trading candle. Next, the 5 a.m. candle. There's really only one that you really want to see at 5 a.m., which is typically a tight consolidation range. Sometimes this may make a new higher low of the day. Sometimes it may not. Generally, the higher low of this candle must hold to be considered valid, but it's not 100%. And I'll show you some examples of that later on. Okay. So typically after 1 a.m. closes, you want to see price between 5 and 9, just kind of not do too much. And that's another reason why you're not trading it. You're letting it build these positions between long and short. That's what the market is doing before it makes its big move in one direction or another. Now, the main focus is the 9 a.m. candle. Why? Because that's when we actually start pressing buttons. Okay, so the 9 a.m. is going to be our main trading range. Okay, so again, we're talking with a open high low close or a open low high close. Okay, between 9 and 1. So this is how that looks. This is just a stock image. So if you're going long, ideally you want to be in by under the open price or below it. Okay, this is the 9 a.m. open. You want to be in somewhere down here. You want to catch the wick and add as many positions as possible on the bottom of the candle as it expands upward. If you're going short, you want to be in somewhere around the wick and near the open price as it expands downward, okay, for a bullish. And then it closes down here. So when I say open, low, high, close, that's what that means. And when I say open, high, low, close, that's what that means. So this is how the 9 a.m. candle in a perfect world does look when it closes by 1 p.m. Okay, so this is 4 hours of price action that you're looking for. Let me turn down my phone notifications because they can be loud. Gotta love being in a group chat. So give me a second to do that. And okay, let's keep going. So the question a lot of people have is, what should I see when I come to the charts? You know, what candles am I looking for? Okay, so these are the three best setups that you're going to see. You're going to see the 1 a.m. candle and the 5 a.m. candle look something like this. Okay, these one too. You can see the 1 a.m. candle looking a tight range. You can get two tight ranges between 1 and 5, both 4 hours. This is a 4-hour example. Okay, 4-hour example. Or sometimes you'll see the 9 a.m. candle and then the 5 a.m. candle inside of it. Okay, so you'll see one of these three. If you don't see something that looks similar to these, there you skip that pair for the day. All right, but this is what you should see: either this one, something like this, or something like this. Right? Okay. Now, what do you look for price to do between 9 and 1 when we actually start trading? This is the traditional pattern right here, where it's pretty much a straight drop. Okay, it may come up a little bit and then just drops to the bottom of the candle range. Okay, obviously, if you're long, you just flip all these patterns upside down. But I didn't want to do long and shorts because just logically, you can conceptualize how it would look. Okay, it's just everything in reverse. Okay, so again, straight drop, that's traditional. The small ranges, you want to see it break out of the range and really just drop like a rock. So you can see that. Or this example is specific because the 9 a.m. candle could sweep the 1 a.m. candle. What does that mean? Notice right here how this high did not get broken. Okay, 5 a.m. stayed inside of it. So obviously, though, we still like to see the high of the 1 a.m. get rated and then close below. I'm not looking for a straight drop if I see this. I want to see price go above, okay, above, especially if this candle makes the high of the day. I want to see it go above, and then when it closes back inside of the range, the 1 a.m. range, I look for price action to go all the way down. That's what I look for, okay? The most common one you'll see these two, this one and this one, more than you'll see this one. But all three are possible. So I just want you to know what you would do should you see one of these things. Now, the golden zone. All your trades should take place inside of a slim area, okay? And this is the area. For shorts, all your trades should take place above the 9 a.m. open, okay, which is this black line right here, and below the top of the 9 a.m. range, right here. That's your trading pocket. You want to get as many entries as possible as price goes into your favor as price falls right there. But at least your base position should be here. Okay, if it's all the way down here, this will give you the highest risk to reward. Okay, and then obviously for long, same deal. This is the 1, 2, and then when you start trading at 9, you want to try to trade below the 9 a.m. open price, but above the 1 a.m. candle low. Okay, that's where you're trading, this golden zone right in there. That's where your first entry should be. Now, there is an optional indicator that I'll show you how to set up. It's called Session Open Price by Intrusive FX. And what it'll do, it'll just put a black line on the chart to show you your 9 a.m. open for your main entry level. Okay, so I'll show you how these are the settings right here, but I'll also set that up for you. And then I just gray everything out, but it really on default, it shows you the New York open, London open, and Frankfurt open. You don't need any of that, okay? And I'll show you how to do that in a second. So when we put it all together, this is what we have, okay? We have 1 a.m. right here, sets the trading range. 5 a.m. 4-hour candle. Below the 1 a.m., ideally likes to close inside of it or at least near it. And then this is our trading range. Remember I talked about the 9 a.m. open right here. It's not shown on this chart, but when a green candle shows, this is your open, low, high, and close. Okay, but your entries should be down here. Okay, remember we talked about the golden zone? You're trading below the open, but above this candle's low. So all that right there in this little wick area, that's where you want to start trading at. Okay, so that's where you should be. And take profit is always at the range high. Okay. So this is how this is a 5-minute chart. Okay, all entries we like to take on the 5-minute. So this right here is this candle right here. This third candle on the 5-minute chart. So this thin black line right here is the 9 a.m. open price. So our entries are below 9 a.m. open, but above the candle range low. Chops around a little bit, but still hits the top of the range, no problem. This would have been good for a 1 to 3, assuming a 10 pip stop loss. Okay, so just that simple. So here's a pro tip. If the 1 a.m. range and the 5 a.m. ranges are small, 9 a.m. can have an explosive move. This will be one of the few times where you may want to give it a little room to keep going down. You can get more than the range bottom as a take profit. So let's take a look at this long red candle right here to see how it looks on the 5-minute chart. Okay, so this is the red candle that I just showed you in the 4-hour one. Okay, but this is the 9 a.m. open right here, this black line. So price barely poked above it. It gave some slight retraces here. So between 910 and 935, you could have got in. This was a 96 pip drop as it broke outside the range. Okay, there was some consolidation at the range bottom, but then it continued to tank. Okay, but all this is a 4 hour period. Ideally, we like to be out by by 1 p.m. Ideally, okay, because this is still just a 4. All this happened in 4 hours. Okay, 96 pip drop. Okay, so candle range theory is a framework, but don't look for perfection. Okay, like for instance, this right here is I call it an imperfect 159. What do you mean by that? Well, you have a 1 a.m. trading range right here, candle high, candle low. Then you got this, which sets up perfectly. But notice what this candle did. It opened and it swept the prior two candles. Okay, so this low, I mean, it got rated. While we don't like to see that, I want you to be aware that it can happen. But just keep in mind, if you get stopped out or if you see price do this, give it a little time to see if it's going to come back and start to close inside the range. So let's take a look at this large 9 a.m. candle on the 5-minute chart to see where our entries could have been. Okay, so this is the golden zone right here below the 9 a.m. open. But this black line, I should have made it red, but this black line here, okay, is the low of the 1 a.m. candle. So really this area right here between this candle and this candle is our trading range. Okay, so you want to be above the range bottom, this black line, but below the 9 a.m. open. So it didn't give much time. Now, trading right here, down here, you're trying to kind of rolling the dice a little bit. I should have made this zone a little shorter. But at the end of the day, between these two black lines is where you could have entered. So you could have got in like right here, not the best, but near enough to the open zone whereby it would have, gone up and just hit profit eventually because it did hit the take profit of the range high. Okay. So again, you're not trading outside of the range. You're trading between this green line and this black line below the open, but above the candle range low, which on this 5-minute chart is right here. Okay. So that's that. So small bodies leading the big ones. This is another example here. Let's take a look at this large red candle. Again, we have our 9 a.m. open. Price goes above it a little bit and then tanks. Could have got in right there between 9:15 and 9:25. This could have given you 1 to 5 risk to reward, assuming a 10 pip stop loss. Okay. This one right here, another two small bodies leading to a very large drop. Okay, so remember, this is like just 8 hours of consolidation where small, tight pack consolidation can lead to a breakout in price. Okay, so this was a straight drop, but we have our 1 a.m., 5 a.m., and then straight drop. Okay, let's take a look at how this candle looks. Okay, you could have got in right at 9 and then just bang. All right, that would have been good for more than 1 to 5, but it's all there for you right there. 4 hour period, you're done. Okay, but this large red candle, this is how it looks on the 5-minute chart right here. This is just from 9 to 1 right there, and all that would have been yours. Now, you do have more confirmation with fair value gaps in the 9 a.m. candle. If you don't know what a fair value gap is, it's just a gap that's created in price. It's a 3-candle pattern where you have the top candle, price shoots down and then shoots down again. Okay. This gap in price just shows that price moved so fast that it didn't have a chance to retrace and go back into this level. So when you see fair value gaps, they can add an extra confirmation layer to let you know that you're in the right segment of the move. Okay. So are they required? Do you need to know this? Do you need to become a fair value gap guru? No, you do not. At the same time, though, they can help to just say, okay, well, in this, I'm in the right segment of the market because I see momentum's really picking up. Okay, and then you get 2 more gaps down here. All right, so that's that. Now, with an imperfect 159, remember that I just said that the 9 a.m. may sweep the high or the low of the 5 a.m. range or the 1 a.m. range, either one of those. But once it closes inside, it's safe to trade. Okay, and as well, the 5 a.m. may form an equal high or low with 1 a.m. and then 9 a.m. may give the big move. So what does that mean, though? It's easier shown than explained. Okay, so once again, you have a 1 right here, 5 right here, and then notice what the 9 a.m. does. Sweeps all the way up here and then goes down. Okay, that can happen. Because remember I said candle range theory is not perfect. It gives you a general framework. This is still a valid range. So don't freak out if you see price start to shoot up. You still just need to wait for it to come back inside the range. And then ideally you want to see it hit the other side. That's what you want. Okay. And this is how that looks. So this price action on the 5 minute is this large red candle right here. So this is the 9 a.m. open. If you took a short down here, you may have got stopped out. You may have got stopped out right here too. But eventually, you could just set a price alert at the range high or even near the open price at 9 a.m. because price fooled all of these longs and then it came all the way back down and killed it. Okay. So the best entry on this one would have been at about 10:55 a.m. It swept the 5 a.m. range high and then did a straight drop. So when price comes back inside the candle range high, that's when you want to start taking advantage of the drop. Okay. And that's all you're looking for. This is the price action you're looking for. It's a straight drop. Okay. And then here you have another one where you have an imperfect 159 because you see the 1 a.m. candle held its low. The 5 a.m. candle, it got close, but it didn't hit it. And then you got boom. So this is, again, it's just two small bodies leading to a large body. Okay. So let's see how this large green candle looks. So this is our trading zone right here below the open price, but notice how it's also above the candle range theory high. This is fine to trade. Okay. And you just enter and enjoy that nice clean ride up. But you're really looking for a straight away price action. Okay. But remember that the reason though that you wanted to see this breakout was because there were small bodies here. Small bodies lead to big ones. Okay. Especially if the pair has a high ADR. Now, another bonus tip is if you want to use fair value gaps to scale into the trade, that can be an option. So for example, this right here is, we just saw this a few slides ago, but the thing is, notice how you have one entry here, another one here near the fair value gap, a smaller fair value gap here. So when it appears, you get it again. And then another one here. This is outside the range, but this also gave another 32 pips. So I just included the pip count of each one. So this first one on the top gave 1 to 9. This is assuming a 10 pip stop loss on each of these. So it gave 1 to 9. This one gave 1 to 9. This one gave 7 times risk. And this one gave 3 times risk. One of these, if you can catch one of these types of moves a week, you're good. If you could be patient enough to master this, you would be get good. Because what do I mean by that? Let's just say hypothetically you're risking $10 per trade. The first entry would be worth $90. The first one would also be worth $90. The third one would be worth $70, and the other one would be worth $30. So that would be a $280 day. All right. Thinking long term though, let's say you're risking $100 per trade. Okay. And obviously you'd have to have a big account in order to support those positions, obviously. Okay. But you're talking about at $100 risk, 1 to 9 on $100 risk, that would be $900 plus $900 plus $700 plus $300. That's a $2,800 trade. Okay. Either one. The only thing that's changing is the size of the account. That's it. Okay. But the trading action is still the same. Okay. But that's the power of scaling in. And then one last tip as well, if you want to scale in, I would recommend one tip you can use is to make the stop loss either your entry price. So what I mean by that, once these two trades show profit and you enter, say, this third one here, excuse me, this third one right here, the stop loss for this third entry could be right here. And these two you could just set to break even. Right. And then when you take this trade right here, all these stop losses, this one, and this one would be just, this one would be break even. And these two stop losses would be set right here. Now it's active management, so hopefully you have the time to do that. But at the same time, that'll help control your downside. So that's one thing you can employ. Instead of just letting it run or just not using a stop loss at all, control it. Because worst case scenario, let's say you enter this trade and then you set it to break even and then it retraces and takes you out, you can just get right back in. Because these fair value gaps, if a fair value gap is valid, it won't disappear. It'll stay intact. So, and as far as the fair value gap indicator, I use the one by Nephew Sam, but you could just go to TradingView, type in fair value gap, and there's tons of them that'll show them to you. So that's fairly easy to see and figure out. All right, so we went over that. So backtesting made easy. Here's what I do. I use the chart setup that I'm going to show you, and all I do is I look for the 9 a.m. open price. This is a 4-hour chart. And once the 9 a.m. open price is highlighted, I look for expansion candles above or below these lines. So this black line right here is the 9 a.m. open price. If I see a big one, I just check the 2 candles before it, 1, 2, and then candle range theories just pop up. Now your brain may be different than mine. And you may not see it as easily, but that's just how my mind works. So I just look for the expansion candles at 9 a.m. and then I have a 159. This is 159. Perfect. Notice how this open price right here, you got an expansion candle, but look at these two candles before it. Is this what I'm looking for? No, it's not. So that's not valid. But this one, I see an expansion candle. So I just check candles. 1, 2. That's the range high. That's the range low. So this is a 159 pattern easily. Okay, so once I see an expansion candle, I just check the preceding candles right beside it to see if the candle range theory is formed. And if it has not, this one did not. That's not even an expansion candle, so I wouldn't bother looking at that. And just go through it like that. A couple more examples. Here's an imperfect 159 because here's my 9 a.m. candle right here. See the black line? So this is 9 a.m. Price went up. It swept these two highs, 1 and 5. It swept both of those and then went down. So that's an imperfect 159, but I will count that. This is invalid because this isn't even an expansion candle, and I checked the 1, 2 candles before that. It just doesn't add up. This one is good though because it expanded a little bit and it completed this range. 1, 2, these candles, you just have a low, lower low, higher low. That works. This one has held as well. This is a large move to the downside at 1 because I see the black line. 1, 2 candles. Okay, this is my candle range theory because it's a high, higher high, lower high. Okay, so same basic principle. That's the 1 a.m., 5 a.m., and my trading range right there. So that's how it pops up. So let's set up a chart now. Let's get to the fun part. So on your trading view chart, got a blank canvas here. For indicators, all you really need is, I think I already saved it to my favorites. Let's see, session open price. There it is by Intrusive FX. I'm going to click that. Okay, and then you should see like some lines pop up on your chart. Let me see. It might show up on the lower time frame. Let me check. Okay, yeah, you see those. They're kind of hard to see. You see these dashed lines here. So what I do is I just go to the settings. And since I want to see 9 a.m., I changed the New York Open to 9. And I think I had like 9:15 or so. I don't know. Line style is up to you. I like solid, and I changed the color to black. Okay, and then the rest of these I just white out. I change it to white, and I put the opacity to 0 so they just don't even show up. You don't need them. And color white. White. Opacity to 0. And I just get rid of the others. You really don't need them at all. Don't even need to show the label because you already know what the session is there for. Okay, I think that's all of them. All right, so then when I'm done, I should see just one black line at 9 a.m. Let's see. Let me see if it's going to pop up on the 4-hour this time. Okay, and there we go. All right, so here are my lines, 9 a.m., 9 a.m., 9 a.m. Okay, so you see that. When you do that, be sure to save the chart template. Okay, so do that. So now what I'm going to do is I'm going to go ahead and bring up my template here like that, but it's the same thing. And then for the sake of a back test, I'll show you a couple of examples on a random pair. Let's just say euro dollar, just for example. I'm going to go back a little bit. And okay, let's say I'm looking for candle range patterns here. So again, this is just how my mind works. You may see them differently than me, but like I said, the first thing I'm doing, I'm checking these black lines for expansion candles. So I see one right here. Here's the line. Let me make this big. And then I check the preceding 2 candles. 1, 2. Perfect. Okay, because this is the candle range low. This is the candle range high. All right, so that's 1 a.m., 5 a.m., 9 a.m. Okay, perfect. This is your 159 right here. Done. Okay, and then you just study this. This is the only pattern you're looking for. That's for a long. Okay, predicated by the black line expansion candle. So I study that. You know, it's the same thing over and over. So let me see a quick short example, then we'll wrap this up. Let's see. So I'm looking for red expansion candles. Here's one, but that's not a valid candle range theory. So I keep looking. And if I miss one, I mean, it is what it is. I'm just doing this on the fly. Okay, here's an imperfect one, but it's a big move, so I'm going to count it. Well, you know what? That's kind of tricky because I was looking at this one, but that 5 a.m. candle is a little, it's just imperfect. This is, you play it by ear because, like I said, it's not perfect. But did this high really, really get broken out of? Not really, because 9 a.m. gave a slight poke and then boom, it dropped like a rock. I don't know if that was news driven or what, but these are two small candles that led to a very big move. So that would have been the range high, range low, and then the breakout at 9. But let me see if I can find one a little cleaner. Get rid of that. Let me go to another pair. Let's just try EuroCAD. And looking for a red drop here. Is this one? Yeah, we can do this one. All right, so here we go. So this is a red expansion candle to the downside. I look at the preceding candles. That's the high of the 1 a.m. candle. Here's the low. Okay, and then that's it. Okay, because I want to be out by 1, but there you go. That's your 159 right there. Okay, simple, easy. All right, very, very simple. Let me go one more so the line will appear. Okay, so there's our line. You see how big this move was. This was for right at the open price. Well, down a little bit, 23 pips or so, 23 pip drop. Okay, so could have scaled into that. Maybe got 1 to 2, maybe 1 to 2.5 or so. Okay, but that was that. So in conclusion, let's wrap this up. Okay, simple, repeatable patterns can keep you paid. Okay, remember that not all ranges will be perfect. Sometimes the high or low of the 1 a.m. range won't get swept until 9, not 5. So watch out for that. But the goal is still the same. You only trade when price closes back inside the high or low of the 1 a.m. range. Okay, 1 a.m. range is very important. Okay, if both the 1 a.m. and 5 a.m. ranges are small, look for 9 a.m. candle to be big. Okay, look, expect a big move. Risk management is still new rule number 1, so small losses and big wins. Let the losing trades lose. Don't fret over those. You just have to get into the habit of adding to winners. You want to be wrong small and be right big. Okay. Now, if you don't think if you get 1 to 2, 1 to 3 or more, don't take the trade. If 1 to 2 is a little low for you, don't take it. Like if the candle range, if you're, and what do I mean? Let me be more specific with that. Let's say for this one right here, let's say you're only going to get like, see, short. If you think you're only going to get, like this here will be a 30 pip move. But let's say to the bottom of the range between your take profit and stop loss, you're only going to get about 24 pips. If that's not enough for you, then don't take the trade. You have to have a standard. Okay. If you want to at least get like 30 pips per trade or something like that, and if the range isn't giving it to you, look for another pair. I watch all the majors and all the crosses. I prefer larger ADR pairs, but you never know. Okay, you never know. But it's okay to have standards. Make the market earn your money. Don't just go throwing it at it because it'll gladly take it if you do that. Okay, but if you have some standards, then it make it a condition that it has to show you what you want to see before you press the button. So I like 1 to 5 is usually my max R risk to reward. And don't be greedy because price can come back and the 9 a.m. range can't end in a doji. If you can get a 30 to 45% win rate, you will be fine. And real quick, when I say ends in a doji, this is exactly what I mean. Go here, here, here. And I'll just show you one. Like, we'll just say, for instance, this one. Yeah. Even though this isn't a valid candle range theory, I just want to show you this. Okay, this is a 9 a.m. candle right here. All right, so see how price opened? It went up almost 37, what was that, 34 pips, and then it came back down, right? Don't let that be you. Take your profit wherever you can and then get out. Okay, because the price can come back. They're not always going to be so perfect whereby price is always going to do something like this. Because it's very realistic, and I've seen this. Price will go down, it'll hit the take profit, and then it'll close like back here and form another doji. So the best, safest bet if you're trading this is to take your profit right here at the candle range theory low, maybe slightly below it, and then just be done for the day. Otherwise, like I said, those last like hour or so, don't think that it can't come back, because it can. I'm telling you that. So don't let a large win turn into a stop out or a small win. Okay, if it hits your take profit, be happy with that, close it out, and be thankful for your trade. Okay. So, but that's our deep study on the 159 candle range theory pattern. I hope you got something out of this. If you have any questions, you can definitely leave a comment. I appreciate all the subscriptions and all the comments that I have gotten thus far. And I hope you have a great rest of your day. Please take care.